Welcome to another episode of Newcastle Unlocked. I'm your host, Brent Sinclair, and today I'm joined by the Brain Trust. Always good to have you guys back. We've got Dan Barry, Head of Industrial here at Knight Frank, and Matt Shaw in Commercial, one of our partners as well. So thanks for joining us, gents.
Thanks, Brent.
Two of the best looking humans in real estate, but here for your insights on the market today, mate. So look, we want to kick off, and it's February now, 2026, and have a look back at the market that was 2025. Really going through some of my notes, it's just pretty boring, really, which is not a bad thing. You know, more wins than losses, but on the back of the chaos from COVID, it's quite refreshing to have a year where there wasn't too much drama. You know, we had pretty stable transaction volumes. There was steady demand. The rate cut cycle probably petered out a little bit early, which was something that we weren't expecting. Still getting plenty of deals done, but look, there's still no major CBD transactions. I think a lot of vendors were waiting to see how the rate cut panned out before taking their properties to market, but with the potential for a rate increase as early as today, I think a lot of them, were resigned to the fact that now we're in the market and it's time to do deals if they're willing to do them. We've still got elevated construction costs. That's persisting. Frustratingly, higher inflation is still persisting. But look, on the flip side, there was no major economic catastrophe. So whenever that's, whatever year we're in, it's a good year. But it has been chaotic. If you look back since COVID, we've had obviously fantastic capital value increases, but then we've had sharp increases in interest rates. So it has been a real chaotic period, and it's affected the market disproportionately as well. We've had several asset classes benefiting and others not so much. So last year was really one of those years to keep the stress levels down and get familiar with doing deals in a stable market. What did you guys see last year? Any takeaways?
I think probably the main takeaway for me is how adaptive the market became. So, say let's focus on, in my sector, industrial land as a product that we're trying to sell. Instead of selling it to someone that's going and building a 50% building footprint, distribution warehouse or workshop, obviously the construction inflation had impacted that. But what we started to see is we started seeing a different purchaser group. We started seeing people buying them for depots, dealerships, lower site coverage sort of options. So we were still selling the product, but it just adapted to a different user.
Yep. Yeah, I agree. What about you, Matty? What did you see?
Oh, look, I think the biggest thing I saw was probably away from the typical sectors we play in, being commercial, industrial, just with the strength of the residential market, like just broadly for the Hunter and sort of Port Stephens and Maitland areas. Like we saw, suburbs like, I've just got a table here in front of me, Merriweather, up 7% over the 12 months to end of 25. Cooks Hill, 14%. Lochinvar, between 27 to 35%. Housing growth, just showing that area is a huge growth corridor, not only for residential, but also for, industrial and commercial development. The other areas like, Raymond Terrace and Charlestown, sort of double-digit growth as well. So I think that's one of the biggest takeaways, is just how strong and how well the residential market has just powered through, as you say, the chaotic nature of what's sort of happened over probably not the last 12 months, but the few years before that. The residential market, rates up, rates down, it's still powering through. So that's a really interesting thing to sort of take, and gives, shows that the confidence in this region as well.
I think it's a good yardstick for the wider property market as well. There's a lot of data that we can rely on, especially in a regional market like ours, like having a look at some of these trends, and we'll get into some of the economic snapshot with building approvals and cash rates and things later on. But yeah, having a look at some of those numbers, like Maitland, 15% growth in a year is just incredible. That market, that growth corridor is just on fire. We're looking at median house prices out there of 870, 880,000.
Yep.
We've got median house prices at Charlestown $1 million.
Yeah, $1 million here for Charlestown. I'll throw a few numbers there.
Yeah.
New Lambton, 1.13. Cooks Hill, 1.625. Merriweather, 2.2. Yeah, Lochinvar, as we touched on, 870 to 875,000. Like it's all up at around $1 million. So, a lot of that is driven by, for new product, to get them out of the ground and, buy land, build a house on it, it's going to cost you $1 million. So it's interesting that we've gone from, a wider median house price of probably, I won't have the numbers in front of me a few years ago, call it 700,000 to now, $1 million across the whole region.
Yeah. It's a reflection of the supply, demand supply dynamics, of course, and you'd have your head in the sand if you hadn't seen the news on how that's trending. It just looks like demand is just outstripping supply, and that's being reflected in these growth pricing nationally. Looking at the numbers, 8.6% nationally growth for residential housing, which is incredible. So a lot of those suburbs, talk about Maitland, etc., exceeding the average national house price growth. Now, what I noticed at the end of last year, there was a flurry of, especially the back end of last year, I felt like it took a bit of time to get going. And as we say, the market it's probably disproportionate in a lot of the asset classes and a lot of the assets that we're dealing with. But the investment market seemed very, very strong, especially the back end of last year. There's no shortage of capital, and there was pent-up demand even pre-COVID, which I know was a long time ago, but I don't think that's ever gone away. And I really do think there's plenty of cashed up investors, particularly for our market, a lot of private investors out there wanting to deploy capital in direct property. And we sold about 40 million's worth of largely investment stock in the last week of the last week of the trading year for us, just before Christmas. Two of the ones that I sold were up at Charlestown. We sold a private hospital investment, 5 years left, to a national institutional backed hospital provider. That went to auction, spirited bidding on the day. I think achieved a really good price for a strata suite in Charlestown. We're talking about 7,500, a bit over 7,500, 7% return. Thereabouts, a 7.1% return, 5 years left on the lease. And the fact that it was more that the investors came out to bid at a price, and that was a price point of 6.6 million. So in that bracket, you really are talking, for Newcastle, your high net worth investors. It's below the funds, and it's above your mum and dad investors. So and then off the back of that, we sold the top floor in the same building to another investor as well. So, and that was for 3.6. So we're talking in that sort of upper end bracket of our local and high net worth investor market.
Well, the other thing with that too is that those square metre rates you just quoted, call it 7,500 a square metre, they're still at a big discount to replacement cost.
Yep.
So the fundamentals there, are strong for the investor. You're buying something at a discount to replacement cost with an attractive yield attached to it, with a strong lease in place. So there's certainly still value in the market across all asset classes.
Well, I think that is really the big feature of what we're going to talk about today. I think we saw it last year. We've spoken about it in our previous podcasts. The value that's sitting there in the market, buying existing stock well below replacement value, and I'm talking well below replacement value. We're seeing a lot of new builds, even in the strata realm, or refurbished builds as well, trending up over 10,000 a metre. And to buy a hospital fully fitted out at 7,500, and then even some office space at 6,000 a metre, that's a significant difference to the new builds. That's 40% discount.
Yep.
And that's going to show up.
That's not even factoring in land in some cases.
That's right. And that's going to show up. That's going to show up not in the long term. That's going to show up in the medium term, because the rents are going to catch up, which has been a feature of industrial discussions with investors. I think a lot of industrial investors, especially the high net worths in our market, and as I said, I can't speak for outside of Newcastle, but we've seen the investors come in with focus on buying, especially industrial property, more so probably the earlier part of last year or the middle part of last year, and it's starting to wash through into some of these other asset classes, that there's so much value in built stock. Even the value add investors, they're not having to wait 10 years to get there. They don't have to hold it. You can literally buy it now, and in the not too distant future, without risk, with tenants, without too much risk, enjoy the income, sit back, not take on the developer risk, not take on the planning risk, and have that upswing. And we're talking the difference between replacement value in a lot of cases, 40%.
Well, I think like now, industrial investors are deliberately favouring a shorter WALE. Like what was originally, 5 years ago, 10 years ago, considered risky is now rational. And that's the main difference. Why is that? It's, well, if you bought a building 5 to 7 years ago and that tenant had fixed increases, well, there's reversion today. So the gap between existing rents, market rents, and then even again, new build, like a D&C economic rent, there's a big gap there between those three. So even if you, like what I've found interesting is you're looking at, say, an economic rent from 5 to 10 years ago, there's still growth on that.
Even
now.
It comes down to scarcity and construction cost. Scarcity of land and the construction cost that's where those numbers are at well north of $200 a square metre for industrial because of those two things. So.
And it's been a focus point for industrial, but it's just interesting. It's starting to show up in conversations that I'm having within other asset classes, and it was always going to, but it's just even with an office leasing market that's sluggish, investors have been buying tenanted office investment or tenanted commercial investment with the rents. As long as there's leases that get you through this sort of sluggish period, they know that reversion's on hand. That reversion can get you through, and there's that limited supply coming through is really going to show up. So when we sold that stock at the end of last year, and even recently, I had a discussion with a client who's got a lease in place. It's actually for commercial/retail property. And we're not talking big dollars here. We're not trying to. This is a market that's there's plenty of occupiers out there as well, and they're really to benefit as well if they buying some of these built stock where they've got a use for the space and they can pay an economic price as well. They're going to get the benefit of it because it's going to show up in a few years' time. So we're in an interesting market, and we're not talking top end, although they're still getting the same benefit. Where you've still got those occupiers and come in, and they have got appetite to acquire built stock, and they're going to get the best benefit from capital growth. Whereas a lot of the sort of true investments with rents that are potentially, or leases that are an anchor to value, or have cap market reviews, things like that, where you can't unlock that reversion play. Can be a little bit more tricky, especially in the non-industrial sectors. But I think that was a big feature, and I think that's some of our predictions coming for 2026 as well. Looking before we sort of get onto what's happening locally outside of some of the asset classes, what in terms of industrial, can you run us through, give us a bit of a snapshot of rates and vacancy rates and what you saw at the end of last year? How's everything's trading? Obviously, industrial land has been on fire. Is that stabilised? Can you run us through and give us a bit of an overview?
Yeah, sure. So to start with vacancy, I think the vacancy rate, which traditionally was probably hovering around 5% in this market, it has increased. There has been some supply coming on. Obviously, you've got areas like Black Hill, Heather Bray, and in a couple of years' time, Loxford coming on. So there is going to be more options in terms of leasing stock coming on. So I think it's safe to say that vacancy rate has increased.
Coming off a very low base, though.
It's very low base.
Almost zero.
Correct. That's right. That's right. And, and this is why this reversion is occurring, because you've got passing rentals of, anywhere from 150 to say 185 a metre, and then you've got new build rates needing 220.
Yep.
So even like I did a rental review the other day, and this was a property that I sold 2 years ago, and we geared it up for sale under a short lease scenario, going in at 175 a metre, which was sort of pretty healthy at the time. Looking at the evidence now in the market, well, it's now 195 conservatively.
Yep.
So, from even if you say adopt a midpoint, go back and forth, it was at 190, that's only an 8% increase from 175.
Yeah.
So it's not like there is still that opportunity from rents that have already been reverted. So I think if we look back on our previous podcast we've done here, I sort of alluded to it being a 2-year process. Well, I think as we sort of are approaching that, like it's going to be every bit. Maybe I've undercooked it in my predictions. So,
well, hopefully,
or it just continues. Yeah.
Yeah.
Like as you say, like there is new supply coming, but it's still got some time attached to that land coming out of the ground and available and registered and ready to build on. So
yeah,
there is more upside there potentially.
correct. And where I have been seeing the opportunity for Newcastle is because our land price is great value compared to capital markets. We are seeing these larger dealership sort of facilities that are building a 20-30% site coverage and making use of that surplus land at a discount to the capital markets. So, and when you're talking that sort of use, the build price doesn't really matter. And even if you're quoting an economic rent to them, $300-$400 a metre over a 20-30% site coverage is okay.
Yep. Yeah. Particularly when a lot of those dealerships, a lot of that built component of it will be like more a showroom type use anyway than versus traditional industrial.
Correct. Yeah.
Yeah. And what's land sale prices? What are they transacting at? Can you give us a quick snapshot of some of these transaction prices?
Yeah. So I guess the top of the market's Mayfield West.
Yes.
So there's sales around 1,000 a metre there, unusable. So I guess key takeaway here is unusable.
Yes.
Is the
most
often
coming. Yeah.
Yeah. So you're probably stepping down to around 650 to 7 in Beresfield, depending on the size of the lot. And then you're around 500 Heatherbrae.
Yep.
And then your sort of Rutherfords, your Tomicos, you're sort of anywhere from 350 to 450, depending on what it is.
Yep. And who's been buying the land that you've been involved with? Has it been developers, investors, occupiers, specific asset classes?
Yeah, so it's still very owner-occupier led.
Yes.
I would say the development market has cooled a little. There is still people that are looking for opportunities, but like we alluded to before, perhaps they're going more into existing built stock and doing a refurbishment or something like that. But who's been buying? Well, in particular in Heatherbrae, it's dealerships, depots, yards, transport facilities. So lower site coverage, pretty much immune to inflation of build prices, and it's going to have a highway next to it.
Very interesting. So in our synopsis of last year, and I suppose looking at Newcastle generally, the projects that we're seeing coming out of the ground or nearing completion, there's several. One National Apartments completed, Chapter Apartments completed. The Store and Dairy Farm is well into their build. They're looking great too. The Domers store, so is Dairy Farmers. They're coming out. They're really transforming that. Our office is down the West End, of course, so we see it regularly. But the facade on Domers looking amazing, and I think that'll just really be the catalyst for a lot of renewed development out that end. Because on the opposite side of the street, she's looking pretty ordinary at the moment. Denison Street. I know G2H's got a bit of land down there, and they'll no doubt transform that. But I think that's been a really good couple of projects for the West End. We've had the Ramsay and IPN medical facility out at Charlestown that was completed, and that's really good to see development of that scale, approaching 10,000 square metres in Lake Macquarie, and fill up pretty good too. There's a few spaces left, but that's really, I think, a great boost for that area. Not another apartment project as well. Not to say they're not welcome, but it's just good to see a few different projects coming out of the ground. NGM, being Newcastle Perm and the Greater, has committed to move into a new, or build and commit to move in and lease some space on the former Spotlight building, which will complement the one apartments as well. So that'll really be a great sort of gateway site as well, leading into the peninsula of Newcastle CBD. So I think that I think they're really good things. We've got industrial land, and Dan, you might sanity check me here. Heather Bray's still got land available. Black Hills come out the ground. Still available land at Mayfield West, and Curry Curry is going to be coming on the market. What's happening with Curry Curry? Can you give us some?
Yeah, so Loxford it'll be ready late 27, early 28.
Yep.
In terms of Black Hill, developer stocks being retained to stage 2. Any lots you're seeing there are predominantly resale opportunities for now.
Mm-hmm.
And I think that's going back on what I said before.
Mm.
That's that they can see the rental growth coming. Like it has been tricky to make some of these bigger projects stack up. Well, it's going to have to come at some point. And that's where if you're holding the land, you've got the opportunity to capitalise on it. So, you've got obviously Black Hill, Loxford, Heather Bray, which is going to be in a nice sort of tight precinct once that M1 extension goes through, because at the moment you're talking 15 minutes Heather Bray to Black Hill in pretty horrific traffic, where that's going to go to 3 to 4, and then Curry Curry's only down the road too. It's another 10 to 12 minutes the other way. So
very complimentary to each other.
I think that
and that M1 extension, which is coming on leaps and bounds.
Oh, absolutely.
I only drove past it the other day, and you just look at the infrastructure they put there. It's still got a ways to go. Was it 2028 that it's going to be completed? But I think some of the off ramps are being utilised now, and they'll be able to activate some wine areas. But it's amazing just to see it and what it's going to do, because all the locals have been caught in that traffic, and not just holiday traffic. It's that Hexham sort of interchange is a schmozzle. So I think that that'll be really interesting. Look, unless I've missed it, there's no major announcements from HCC on the Honeysuckle HQ land at the moment. That's a big piece of Newcastle and what's going to happen there. So hopefully they give us some direction on that, just as for the town. I think that's a key piece of real estate to activate. And no major land releases residentially either. Plenty in planning stages. There's plenty, of discussion. But there's been nothing in the last sort of 12 months that's really sort of stood out. I know out at Cameron Park they're hooking in. There's several other established Wemailer as well. But nothing substantial. So it has.
Well, that's what's put that lack of land being released or being delivered is what's driving the pricing in a lot of instances for residential. Now land is going to cost you, the best part of $500,000 to start, and then you're probably $600,000 at a minimum to get a nice big 4-bedroom project home out of the ground, and it owes you 1.1 or over $1 million. So that's an interesting phenomenon in itself.
Yeah, well, a developer client of mine made the same point, that it was the first market that he's seen. I'm not saying sitting here but the last couple of years, that you buy and build in an estate house and it's valued lower than what you paid for it.
Yeah.
Not saying that that's more of a general statement, but it's a reflection. We've got this housing crisis, obviously, and nationally house prices have gone at 8.6%. So there's something to miss there, but that's beyond our pay grade. We'll just give our comments on it.
Well, I think also with that, like it's going back to the apartment market in town. Like if it's 1.1 million, or call it $1 million to go and build and live out there, a lot of talking to the developers around Newcastle that have that are doing the the high rise developments, a lot of the buyers that are coming in are people that would traditionally go out to look out there to buy.
Definitely. Yeah.
And they can pay $1 million. Yeah, okay, they're not getting a house, they're getting an apartment, but they're changing their view on the way they're going to live, much like you would see in your capital cities, Sydney and Melbourne.
That's right.
Much more amenity in town. They're happy to live in a 2-bedroom apartment and pay $1 million or whatever for it. But you've got that amenity in town with the beaches, the cafes, all the things that go with that. So that's interesting too. That's I guess is seeing that the CBD apartment market is continuing to power through as well as the wider residential market.
That's right.
And look, development sites have still been transacting, but I think generally speaking, especially at the bigger end of town, a lot of the developers have thinned out, and this is post-COVID. I think I noticed, especially last year, that a lot of it, with all of the challenges with the construction industry over the past few years, it seems like the developer builders have really come into their own in terms of their ability to do deals and transact, and a lot of the other developers, sort of non-builder developers, falling out. Now, of course, you've still got the likes of Doma and Stronix and these guys getting stuff out the ground. So it's I'm just talking more broadly speaking. I feel like that a lot of the bigger deals are getting done by the builder developers because they can manage the margins. And I think that's a huge opportunity now that it has thinned out and the competition has somewhat reduced, that for some new players to come into the market. I think that there's plenty of opportunity in our market here across a lot of different assets. We're talking medium, high density residential land. I think that it's a massive opportunity to come in for some of these maybe Sydney developers and have a crack as well, which would be great to see. And hopefully with the house prices the way they're going, becomes a lot more attractive in 2026, 2027. But as I mentioned earlier, the alternative products to residential and the bigger projects like the one at Charlestown, it's good to see some of these developers getting in the mix as well. Like we've just sold a site at Hamilton, about $12 million, and that's likely to be a medical and business unit project. Could obviously go another direction, but it's good to see some of these, a bit more variety of development as well. So, and it's good to see some transactions in that space. So more of that, and some more competition would be good to see, more healthy competition. So we've talked a lot about 2025, and I think it'd be good just to talk about where we are and where we're heading as well, to try and give as much foresight from what we're seeing from our vantage point to the listeners and the viewers for what it's worth. So I just had to grab some quick economic data for our indicators. So cash rate sitting at 3.6% today, but it could change at 2:30. The big four banks are predicting a rate hike at some point, but not necessarily a rate hike cycle as well. So we've ended the rate cut cycle. Yes, there's talk it could go up, whether it's today or next month. I think that they've not got inflation. Inflation's still a little beyond the parameters, but it's not predicted that there's a rate hike cycle. Just looking at the last two quarters for inflation, for CPI, 3.2% in September, and what was it, 3.8% in December. So the core inflation is still beyond that 2 to 3%. So that's what's driving these discussions. Again, looking at the housing market, because they've got the data and it's a really good yardstick, clearance rates dropped 57% late last year, down from 70% in the spring. Looks like the total listings in New South Wales, which was a bit over 100,000, this is for residential, mind you, down 20%, so below that five-year average. And that's really, and then dwelling values, as I've mentioned, 8.6% nationally up. So that's really, again, just that lack of supply, even for built stock, coming on, driving some of those house prices. It looks like construction costs are still increasing, but moderately, 2.5% year on year. So it's slowed, but they're still elevated. So hopefully with the value starting to creep up as well, some of these projects are going to be more feasible and get out of the ground across all asset classes as well. So that's the indicators. What's going to be happening for this year? I've got my views. Where do you see, what's some of your predictions for this year? So you, Dan, what do you reckon is going to happen?
I think so. Probably the back end of last year, we saw occupiers leaving the market a bit in terms of built stock. So I think I think they'll come back into the fold to compete with the investors. Like we ran a campaign in Warrabrook at the back end of last year. The three highest bidders were all investors. It was a vacant property in an area that really should have had occupiers leading the demand and the inquiry. I think from there, it's fairly safe to say the industrial market strength, this is from an investment perspective, it's largely driven by tenant demand below replacement cost buying as opposed to a whale. So if I had two properties side by side, one had a 5-year lease that was, let's say it's 150 a metre or something like that, versus with the 5-year lease versus 150 a metre with a year lease, we will get a better price for the shorter whale.
Yeah, because you sit there with 150 a metre with, call it 3% increases.
Yes.
Whereas if you go to renew with that 1 year, that jump could be 25%.
That's right.
Or more.
And I think in industrial, the strongest category in this market is also the best opportunity, and that's 5 to 10 million free. A Torrens building, 5 to 10 million, that is single-handedly, if it's trading anywhere near $3,000 a metre improved, and it's circa 50% site coverage, buy it. If you can afford it, buy it. It is single-handedly the best value, and you're also, but in that pool, competing with cash.
Yeah.
There's a lot of cash. So,
well, I agree. I think, and we've mentioned it, heavily already. I think buying cash buyers above 3 million or above 5 million, there's some incredible value there for buying well below replacement value across all asset classes, preferred Torrens title assets, freehold, vacant or tenanted. And look, if it's tenanted, sometimes it's a negative if the rents aren't right. So I think, but there, the two fronts, you've got immediate upside if you've got the rent reversion, and then you've also got the medium-term upside from just capital growth. So I think that it's, the competing with new supply.
I think the next thing we'll see, I think we're going to see a lot more transactions this year, even based on, the first few weeks of the year that we've had. We have some great stock coming on. And it's
saleable stock.
So it can't not sell as far as I'm concerned.
Love your confidence. That's what you want.
Well, I think just dovetailing on that and probably just speaking a little bit more macro or broadly, there was a lot of volatility last year, like particularly in the US bond market, right? And then, precious metals as well just went through the roof, like gold and silver up, 150% for silver, right? And I think investors view real estate in a similar fashion. It's a safe investment. You can touch it. It's bricks and mortar. It's a great buffer to inflation. If the inflation issue continues to persist, real estate investment's a great buffer to that. So I'm with you. I think you'll see a lot of transactions, occur, and more of the investors coming into the market where previously in industrial it's probably been owner occupier led. It's a safe investment.
Well, I said at the start,
you'll see.
It's just boring. It was boring last year.
Yeah.
That's what you want you want to invest. You don't want it to have these spikes. Like even in the last couple of weeks, looking at the Bitcoin, gold, silver, it's I don't want to stay. I want to stay in our wheelhouse, of course, and not get into it. But it just seems like it's a lot more stable. So you can touch it, feel it, as you said. So I think that we can't get in the minds of the investors, but more exposure to direct property, especially in our market. I think the way things are going, all those indicators are positive.
What about like the buyer's agent briefs we received, David?
Yeah.
What about the yield expectations that have changed on that? Like I saw one the other day that was 4.75.
Yeah.
That was the tightest. But they're well into the fives now.
Yeah, and cheaper than debt. Like it's gonna the debt to go and get that's gonna be what 6.5%. And the briefs come out. Yeah, it's 4.75, but it's always low fives. It's probably come in 50 to 100 basis points in the last 12 months.
Definitely.
On those buyer-led briefs,
Yeah, I think transaction buyers volumes will increase. I think that there'll be a lot of value-add investors looking at repurposing existing buildings to squeeze their returns out of it, whether it's rent or capital growth or refurbishment. I think trying to work within existing building footprints or minimizing your capital outlay where you can. Of course, there's plenty of opportunity in straight development, but it's having that skill set to be able to manage the margins, manage the project, pick the right assets. But for your investor or your value add investor, especially for someone who maybe not from the area is looking in, I think that for all these reasons, I think the market's on sale. Any built stock at the moment's on sale. It's some of them going at bargain prices compared to what replacement value is. So I think there'll definitely be a focus on existing stock and building to that. Of course, we're talking about investors. There's plenty of other opportunities for occupiers, and there's for business reasons for their acquisitions. I think in the same conversation, I think strata assets at a lower price point, but taking an existing building, repurposing it for strata and making it from a wholesale product to more of like a retail product, not as in retail asset class, but a smaller purchase price essentially, and targeting some of these smaller occupiers. A few developers have been doing that quite successfully, and I think that that's really an opportunity. We just had a strata, I think more strata medical. We just had a project complete out at East Maitland, which performed incredibly well. Again, it's just about trying to find those pockets of opportunity and making it work. And that was a brand new development. And I think that that was quite well done. I also think there's probably going to be, we noticed last year there was an uptick in receivership sales as well. I think that will continue to trend. It's not at the dramatic stage by any means. And it's just, again, more of a stable market, another indicator that it was a boring market, but it has definitely increased from years gone past. I think there was just that reluctance, ATO or otherwise, to put too much pressure on some of the market. But I think that there will be more receivership appointments as well, and there'll be an opportunity there. So, but overall, I do think, again, we've had a pretty boring market last year. We can't control what's happening. Obviously, we can't control what's going on at an international level, but for our market, there's still plenty of demand. Inquiry levels are still very high. The last week of the business year in December was incredibly busy. From our vantage point, the listings that we've got coming on are very saleable and appealing. And I think that they will be a good yardstick for seeing how the market goes for the remainder of the year. But I just see it being another stable year. Within, if everything sort of kicks along, I think that even with this potential rate rise, I don't think that's going to move the dial too much. I don't think it's going to have a dramatic impact, even if it's 25 basis points or a couple of 25 basis points. I don't think it's going to dramatically have an impact. If anything, I think it's signaled to those vendors who have been on the sideline wondering when they should or shouldn't sell, wanting to sell, for reasons. I think they'll see that, oh, well, look, this is the market. The rate cut cycle has ended, and now we're in a sort of a stable market. So I think that there'll probably be a few more listings coming on. I think there will be more listings. But again, nothing too dramatic, not too high, not too low, and no catastrophes that I.
But I think that the market is pricing in that there is only one or two rate increases. It's not. Previously they were forecasting multiple, and that had an impact on the market, or forecasting multiple cuts. It's just one or two, right? Yeah. So I think, as you say, that's just going to see it continue to be a fairly stable and, use your word, boring market. But, that's I'm with you. I think that's how it will potentially play out over the course of the year. Mm-hmm.
Well, that's all from me. Was there anything else you guys wanted to add?
No, good.
No, I think we've covered a broad enough range of topics, and I think everyone's listened to us for long enough. So we'll wrap it up there. But thanks very much for coming on, gents, and thanks to our listeners. We'll see you again soon.
Thanks.